You think the stock market is a level playing field? Starting at number 50 and counting down to the most shocking Wall Street secret that costs you thousands every year, these are the hidden rules that ensure the house always wins. And trust me, when you hear number 1, you'll understand why 90% of traders lose money. And it's not because they're bad at trading. Rule number 50, the $25,000 Gatekeeper. Pattern day trading rules require $25,000 minimum to day trade more than 3 times per week. But here's what they don't tell you. Hedge funds with millions can make unlimited trades, creating a 2-tier system where the rich get infinite opportunities while you get just 3 shots. Rule number 49, the invisible tax on every trade. Payment for order flow means your free broker sells your trades to market makers who front-run you. Robinhood made $182 billion in 2021 just from selling your order information. You're not the customer, you're the product. Rule number 48, the 10-second disadvantage. Your trades take 100 milliseconds to execute. High-frequency traders operate in microseconds. By the time you click buy, algorithms have already traded that stock 1,000 times, skimming pennies that add up to billions. Rule number 47, the free money illusion. Stock buybacks were illegal market manipulation until 1982. Now companies spend $1 trillion yearly buying their own stock to inflate prices. CEOs get richer from stock options while creating zero actual value. Rule number 46, the hidden circuit breaker. Individual stocks can be halted, but ETFs tracking them keep trading. Institutional investors use ETF arbitrage to profit during halts while your shares are frozen. They're playing while you're benched. Rule number 45, the borrowed share paradox. Short sellers can borrow and sell more shares than actually exist. GameStop had 140% short interest. Mathematically impossible, yet perfectly legal. The same share can be lent multiple times, diluting value. Rule number 44, the pre-market privilege. Major news drops at 4 a.m. Institutions trade pre-market from 4 a.m. You can't trade until 7 a.m. at earliest. By market open at 9:30 a.m., the opportunity is gone. They get a 5.5-hour head start. Rule number 43, the settlement trap. You sell stock on Monday but can't use that cash until Wednesday. T+2 settlement. Market makers? They settle instantly. Your money is held hostage while theirs moves at light speed. Rule number 42, the options expiration game. Market makers can see all options positions and systematically move prices to make the most options expire worthless. It's called max pain theory, and it's why 90% of options expire worthless. Rule number 41, the retail sentiment tracker. Brokers aggregate and sell your positions, stop losses, and limit orders. Hedge funds know exactly where retail traders will panic sell, then hunt those levels. Your stop loss is their treasure map. Rule number 40, the quote stuffing attack. Algorithms spam thousands of fake orders per second to slow down exchanges, creating artificial latency for regular traders. While your order processes through the traffic jam, they're already gone. Rule number 39, the dark pool deception. 30–40% of all trades happen in dark pools, private exchanges where prices aren't public. Your market orders get worse prices while institutions trade secretly at better rates. Rule number 38, the wash sale trap. Sell a stock at a loss and buy it back within 30 days. You can't claim the tax loss, but hedge funds use complex structures to harvest tax losses daily while maintaining positions. Rule number 37, the spread widening trick. During volatility, market makers widen bid-ask spreads exponentially. A stock normally trading with a $0.01 spread suddenly has a $0.50 spread. You lose 1% just entering and exiting. Rule number 36, the index inclusion pump. When a stock joins the S&P 500, index funds must buy it, guaranteeing price surge. Insiders know weeks before announcement. Tesla jumped 70% from announcement to inclusion. You find out last. Rule number 35, the infinite leverage loophole. Retail margin is capped at 2-1. Institutions use total return swaps for 10-1 or higher leverage. Archegos had 50.1 leverage before imploding. Same market, different rules. Rule number 34, the weekend decay. Options lose value over weekends, theta decay, even though markets are closed. Market makers price this in when selling to you Friday afternoon. You pay for time you can't even trade. Rule number 33, the earnings blackout window. Companies can't buy back stock near earnings, creating predictable volatility patterns. Algorithms know exactly when buyback windows open and position accordingly. The calendar is rigged. Rule number 32. The quote flickering. Algorithms place and cancel orders in microseconds to detect your order size and intent. They're fishing for information with bait you can't even see. Your order is analyzed 1,000 times before filling. Rule number 31. The liquidity mirage. Order books show available shares, but most are phantom orders that disappear when you try to buy. Real liquidity is 10% of what's displayed. The market depth is an illusion. Rule number 30. The rebate. Arbitrage. Exchanges pay rebates for providing liquidity. HFT firms collect millions in rebates for trades that last microseconds. You pay fees, they get paid to trade. Same action, opposite economics. Rule number 29. The Reg NMS routing. Your order must be routed to the exchange with the best price. But best is manipulated by sub-penny pricing invisible to you. Institutions trade at $10,000 while you see $10.01. Rule number 28. The share lending scam. Your broker lends your shares to short sellers, collecting interest you never see. You take the risk of ownership while they profit from lending your assets. Check your account agreement. Rule number 27. The ETF creation mechanism. Authorized participants can redeem ETF shares, arbitraging price differences. During March 2020 chaos, bond ETFs traded 5% below assets value. Only institutions could profit from the gap. Rule number 26. The failed delivery system. Shares can fail to deliver for weeks. Sellers collect money without delivering shares, creating phantom supply. In January 2021, GameStop had millions in FTDs, diluting real shares. Rule number 25. The internalization process. Citadel executes 47% of retail trades internally, never reaching public markets. They profit from spread while claiming price improvement of fractions of pennies. The house is the market. Rule number 24. The spoofing algorithm. Placing fake large orders to move price is illegal spoofing, unless you're a market maker providing liquidity. Same action, different label. The law has built-in loopholes. Rule number 23. The clearinghouse monopoly. DTCC clears all trades, charging fees and setting collateral requirements. They raised GameStop collateral 10x overnight, forcing brokers to restrict buying. One organization controls everything. Rule number 22. The latency arbitrage. Chicago to New York is 13 milliseconds. Firms pay millions for 11 millisecond connections. They see price changes and trade before your broker even receives the quote. Geography is destiny. Rule number 21. The overnight gap game. Futures trade overnight, moving stock prices before open. By 9:30 a.m., the real move already happened. You're trading yesterday's news at tomorrow's prices. The gap is the trap. Rule number 20. The congressional trading privilege. Congress members trade on insider information legally. They bought tech calls before trillion-dollar stimulus announcements. Nancy Pelosi's portfolio beats top hedge funds. Legal corruption. Rule number 19. The Fed minutes front end. Federal Reserve minutes move markets. Fed officials trade their own accounts with advanced knowledge. Kaplan and Rosengren traded millions in 2020 while setting policy. They investigate themselves. Rule number 18. The analyst downgrade dump. Banks downgrade stocks after selling their positions. Goldman downgrades what they just sold you. Their research department is their marketing department. The rating is the exit strategy. Rule number 17. The social media manipulation. Hedge funds deploy bot armies during short attacks. Thousands of fake accounts spread fear. Citron Research and Melvin Capital coordinated media hits with trading. Digital manipulation is standard. Rule number 16. The bankruptcy jackpot. Distressed debt funds buy company bonds for pennies, then force bankruptcy to take ownership, wiping out shareholders. They profit from destruction. Your stock goes to zero, they get the company. Rule number 15. The PFOF prisoner's dilemma. All brokers must offer payment for order flow or can't compete on free trades. Good brokers get pushed out. The entire industry is forced into the same corrupt model. Race to the bottom. Rule number 14. The short and distort. Short sellers publish research reports after taking positions. Hindenburg Research shorts, then publishes. Stock tanks, they profit. If you did this with long positions, it's illegal pumping. Rule number 13. The flash crash engineering. May 2010's flash crash was blamed on one trader, but really showed how fragile the system is. Algorithms selling to algorithms with no human oversight. The market can evaporate in minutes. Rule number 12. The plunge protection team. The president's working group on financial markets can intervene to buy stocks. Government secretly props up markets. Free market capitalism, except when banks might lose money. Rule number 11. The infinite money glitch. Banks borrow at 0% from Fed, lend to government at 3%, risk-free profit. You can't access this. During COVID, banks borrowed $4 trillion essentially free. Socialism for banks, capitalism for you. Rule number 10. The synthetic share factory. Market makers can create synthetic shares through options to provide liquidity. Millions of fake shares dilute your investment. It's counterfeiting, but legal. The supply is whatever they want. Rule number 9. The Robinhood suicide trade. Robinhood showed a teenager he owed $730,000 from a glitch. He killed himself. It was display error. Brokers gamify trading, hide risks, and face no consequences for destroyed lives. Rule number 8. The bailout guarantee. Banks know they're too big to fail. They take massive risks with certainty of taxpayer bailout. Profits are privatized, losses socialized. The game is rigged because there's no real risk. Rule number 7. The order type advantage. Exchanges offer 100+ exotic order types only institutions understand. Hide not slide, post only, discretionary peg, each one an edge you don't have. The rulebook is 1,000 pages of advantages. Rule number 6. The retail restriction power. Brokers can restrict buying anytime, like GameStop January 2021. Terms of service give them total control. Free market until retail starts winning, then rules change mid-game. Rule number 5. The market maker exception. Market makers exempt from short sale uptick rule can naked short for liquidity have T+35 to deliver shares. Every rule has an asterisk, except market makers. They are the casino. Rule number 4. The truth about price discovery. NYSE handles only 10% of volume. Real price discovery happens off exchange. The market price you see is theater. Real prices are negotiated in dark pools. The ticker is a suggestion. Rule number 3. The volatility harvest. Market makers profit from volatility, not direction. They push prices to trigger stop losses and options barriers, creating volatility to harvest. Your loss is their business model. Rule number 2. The systemic conflict. Your broker, market maker, clearinghouse, and exchange are often the same company. Citadel is all four. They see your order, trade against it, clear it, and make the market. The house deals, plays, and judges. Rule number 1. The ultimate truth. You are the product. The stock market isn't designed for you to build wealth. You're the krill that feeds the whales. Every rule, system, and structure extracts value from retail to institutions. The market isn't rigged. It's performing exactly as designed. You're not an investor, you're inventory. The greatest lie Wall Street ever told was that you could beat them at their own game. Now you know why 90% of traders lose money. It's not skill, it's system design. The question isn't whether you can beat the market, it's whether you can survive it. Want to learn how to invest despite these rigged rules? Subscribe for strategies that actually work in a system designed for you to fail. Because knowing the game is rigged is the first step to not being the sucker at the table.